Good afternoon and welcome to another edition of Unlock the Stock. We're pleased today to welcome back to Unlock the Stock TWK. As you know, Unlock the Stock is a platform which is specifically designed for retail investors to gain access to corporate management and to get to know both them and their companies a little better. Andre Myburg, the CEO of TWK, and Andre Giel, the CFO, join us today and will take you through a presentation shortly. Unlock the Stock is only possible with our technology partner, Lumi Global. Please visit their website at lumiglobal.com to learn more about their various online AGM and investor presentation solutions. Our host today will be the finance ghost and Mark Tobin, who will facilitate the Q&A session. Before we start, there are a few housekeeping notes. Andre and Andre will go through the presentation, which will be followed by a Q&A session. You can post your questions by typing them into the Q&A box at the bottom of your screen. The event is being recorded and will be available on the Unlock the Stock YouTube channel, probably by Monday. You will also see an email address when we go into the Q&A session. And if you'd like to be added to the TWK distribution list, please can you send an email to the address and we will add you. Andre and Andre, I am ready for you to share your screen if you want to take us through the presentation.
Yes, thank you very much. From my side also, welcome to the presentation of our TWK's full year results. It's always an honor to share this with you. Maybe for you that doesn't know TWK that well, I'm just going to go a bit through what TWK is. First of all, we are a company that's listed on the Keyter Stock Exchange, and we also have a secondary listing in A2X. TWK is a diverse agricultural group of companies, and we operate in the following segments. First of all, timber. Timber is our core business, and we have supplying timber to exporters as well as our internal markets. We have our different markets in South Africa. That's our mining timber and also structural timber and all the different markets that we supply timber to, and of course also poles as well. In the retail division, we also have our fertilizer business as part of the retail and mechanization business. We have 31 retail stores, and we also have about 5 blending facilities where we blend the fertilizer. Financial services is actually in 2 parts. We finance the primary producers, the farmers, for inputs on their production facilities on the one hand, and we also have the insurance division on the other side. Then on the grain side, we have our storage facilities, and we also have the marketing and the sales of grain, the commodity trading, and also the manufacturing of maize and maize meal products, and as well as animal feeds. So that's more or less the different divisions that we have. I think just a very important thing that to mention before we start with the financials and look at that is that the prior year numbers were restated due to the cancellation of the roof space sale of shares agreement. There's also some reclassifications as well as some changes in the accounting policy. That was very small. We are only changing some of the sale of the retail direct business to only that is only a commission on that side. So it's only on the revenue that there's a little bit of a change on that side. If you look at the year and how we did, first of all, if you look at the revenue is up by 7% to 8.5 billion. Operating profit is up by 8% to 489.6 million. The after profit tax was up by 24% to 245.2 million. Our basic earnings per share is up 23% to 719.28 cents. Net asset value per share is also up 8.3% to 58.56 rands. In the cash from operating activities, that's after working capital, that's up 50% to 634.5 million. This is only for the continued operations. I think if we look at the figures, then of course we are not totally satisfied or happy with that, but it is a solid set of results. And I think in the year what was probably one of our most challenging years is still a solid set of results. If we just have a broad overview of the different segments results, first of all, timber was negatively impacted by the fire damage in the first half of the year, but it definitely improved, where we had a much more improved second half. And then on the retail and mechanization, sales were adversely affected by the macroeconomic conditions. And financial services reported a solid result despite a lower production book. We also can mention only that the insurance did very well on the financial services side. Then on grain, we also had a solid result supported by market share growth. That market share growth is mostly in the commodity trading side. Then if you're looking at the strategy of the group, it remains robust, diversified, with a focused business model. I think if we look at the diversified income streams, it enables us to manage and mitigate adverse market conditions. Capital optimization is a key focus area for us at this stage. Non-strategic assets has been released, like our motors division. That was sold at the end of this year. Then only the buildings that's left, that's going to be sold in this new year. I think it's important that we align our assets with our strategy. So we are very focusing on that to make sure that our assets is aligned with our strategy. Just on the roof space, the transaction was terminated, unfortunately, and the full year 2023 we had to reinstate. That means that we have a reduced profit after tax of about 48 million. And that is still not core business for us, so we will still looking to sell that as well. Fortunately, at this stage, we're still in arbitration, but the moment we are finished with that, we will probably sell that. Unfortunately, I can also mention that it wouldn't be for that 84 million that we have right off at this stage, unfortunately. I'm going to hand over to my colleague, Andre, for giving you an update on, or go through the financials. Thank you, Andre.
Thank you, Andre. Good afternoon, everyone, and thank you for your time this afternoon. I will go through the financial performance of the group, a little bit of feedback in terms of how some of the key numbers on our income statement move, as well as our balance sheet, and then a little bit more in terms of the operational overviews of the various segments. If I can start with the slide that you will see in front of you, I think the one thing that is evident from TWK, and it's also something that we see in the industry, there are some volatility. However, a diverse business model helps you to protect some of that volatility. But you can see that in terms of our profit after tax, operating profit, and that speaks to the seasonality and the nature of the underlying businesses. But if I can start from the left, well, it's my left, so I'm not sure which side it's on your side. But from revenue, you can still see there's a steady growth in revenue that we've seen, a 7% growth from the prior year. And I did mention the change in accounting policy in terms of how we account for direct agri sales. So we've revisited the application of those transactions against the IFRS 15 requirements. And in those transactions, there are not really a price risk or an inventory risk that we carry. We only arrange in the transaction between the supplier and the producer. And for those transactions, we accounted for now only the commission and not the gross turnover and cost of sales. So the impact of that on our revenue number for the current year was just about 1 billion. And then in the prior year, we've restarted the revenue numbers of 1.5 billion. Just to make sure that the comparatives talk to each other, we've adjusted the 2020, 2021, and 2022 numbers also with that impact. So still a good steady growth that we see in revenue. Revenue is mostly impacted by volumes, growth in market share, but then there are factors that we can't control. It's volatility in commodity prices, as well as the rand-dollar exchange rate that also have an impact in terms of how the rate that we need to account for our exports. Then if I can continue with operating profit with 8% from the prior year. It's a combination of our gross profit, our operational gains and losses. So our gross profit the last year, if you've looked at the detailed financials, it is a bit down from the prior year with about 3.8%. And that was mainly due to margin pressure that we've seen in some of our mills. TWK has maize mills, and over the last couple of years, the white maize price was very volatile, and it definitely impacted the margins that we could realize in those businesses. Together with that, with the fire that broke out at NCT, we couldn't sell anything for 5 months because of the production halt, and we couldn't realize any sales, and that also impacted the gross profit margin. Our operating income did increase, mostly because of the insurance claim that we've received due to the fire, the insurance payout that we received on business interruption as well as stock losses due to that. And in total, the insurance claim was 255 million, and TWK received 160 million. Then together with that, I think there was a lot of focus on cost and cost savings. There was a decrease of 8% from the prior year, contributed to the increase in our operating profit. Profit after tax, increase of 24%. The only thing that I would like to highlight there is it is the outcome of the increase in operating profit. However, our finance charges were a bit higher than the prior year. That was mostly due to additional funding required to support the liquidity of the group in that period. We couldn't export, and that was about 100 million, and that resulted in additional interest that we had to pay to the financiers. If we can continue to basic earnings per share, also an increase of 23%, mostly supported by the increase in our earnings that we've seen. If I can continue to the balance sheet, total equity increased with 9% to around itself is 2.2 billion. That was supported by improved earnings. We did pay a smaller dividend in the last financial year than in the prior year. And then also there was a revaluation recognized on our land and buildings. In terms of our accounting policy, we revalue our land and buildings, and that is formally done on a 4-year cycle by independent valuators. There's a rotation cycle in place, which the board of directors approved. So this is a cycle that we run every 4 years and account for those adjustments. Our net asset value per share also increased to 58.56 rand. And then if I continue to gearing, our gearing percentage improved from the prior year, mostly because of repayments on our long-term borrowings. It is repayments that we make in terms of the terms and conditions of those financing agreements with the financiers. And then also our short-term working capital facility was also less than the prior year. It was an outflow of better management of our working capital, especially on inventory. We had less timber and grain stock on hand at year-end. In terms of our share price, unfortunately, our share price came down quite a bit from the prior year. At the end of last year, it was 50.50 rand, down to 26.50 rand. And I think it was just an outcome of what happened in TWK and uncertainty maybe in the market in terms of how the fire and the outcome of that will be on the group's results. So currently down from the prior year, and hopefully with what we have and the focus strategy that we will have, we can get that to grow back at the levels we also will feel more comfortable with. Our dividend per share, last year, a dividend of 1.15 rand was declared. Post hearing at our most recent board meeting, a dividend per share of 75 cents were approved by the board. The lower dividend was due to where we are now as a company and as a group, and therefore we did declare a smaller dividend for the year. The dividend yield, however, based on what we declared in terms of our current share price, is still at 2.8%. The dividend cover currently at 5.4 times, in line with the group's the board's strategy to at least pay a dividend yield between 4 and 5 times. In terms of our cash flow, I think if I can only highlight some of the main cash flows over the last year, we started positively with cash of 115 million. We did manage to generate operating cash of 491.9 million. And then you will be able to see better working capital management within the group, supported our free cash flow that we had available. However, we did pay quite a lot in terms of finance costs, as well as repayments on our borrowings, and then also on our short-term working capital facility. In that, there you can see the financing cost that we've paid is 310 million, and then 276 million that we repaid on borrowings and other loans. So quite a substantial amount that went for that. And then, yes, we continued to spend CapEx we needed. I think over the last year, we were conservative in terms of how we spent and make sure that our decisions that when we buy, it meets our internal rate of return. However, there's a fine balance to also ensure that we protect and maintain our current asset base to still deliver sustainable earnings. So in total, we spent about 61 million. Then also, there's quite a strategic drive to grow in the insurance business that forms part of the financial services division. And over the last year, we bought another insurance company, as well as two insurance books or agency rights. And in total, that was about 34 million, and that you can also see on the slide before you. So that is in short the main movements in our cash flow. I don't think there's anything else that stands out that I think I do need to highlight to the audience. If I can continue to the operational or the segmental review over the last year and a little bit more detail on the 4 segments in the group. So this is just an overview in terms of how the segments contribute to the total revenue of the group as well as the EBITDA. And there you can see that in terms of revenue and EBITDA, our timber segment contributes the most to our revenue as well as EBITDA. Secondly is retail and mechanization that contributes about 33.9% to our revenue. Secondly, grain, and then financial services. From an EBITDA perspective, timber is our largest contributor. Secondly, financial services. And those 2 divisions from a strategic point of view is also the 2 divisions where we are focused to expand more and to grow. Then secondly, grain, and lastly, retail and mechanization. In terms of the timber operational results over the last year, I think many of you will probably have heard about the fire that broke out when you've read the whole year results. And we've also talked to that earlier, and also Andra also mentioned that. But that definitely had quite a significant impact on the performance of this division. And not only did it impact the chipping mill and the results of the chipping mill, but also the whole value chain. I mean, for that period, from the plantation side, they couldn't market their product. And so it had quite a significant impact, and that we see throughout all the businesses in the segment. Okay, so if you can start with the chipping mill, I think the team did extremely well the first 5 months with no production, no sales. They will still be able to meet 60% of our Japanese orders, and in total, by year-end, 89% of our export orders. And I think that is a brilliant result by the team, given the start of the financial year. However, margins were a bit down, mostly because the quality of the wood chips, because of the fire, it affected the quality of the wood chips, and we had to dispose those wood chips at reduced prices in that period. Then if we look at the segment in total sales volumes were down by 40.3%. And here you can see the impact on the whole value chain to about 970,000 tons. And then also what we've seen is that in the markets that we play, so we supply mining timber, and then we also supply industrial timber. In both those industries were under pressure, and it had an impact on our sales volumes. From a mining perspective, we have a subsidiary, Rech, that supplies mining timber. Sales volumes were down. We supply mostly to gold and platinum mines, and over the last year, some of the gold mines closed some of the shafts, and we couldn't deliver those sales volumes to them. And then secondly, from an industrial lumber sales, your do-it-yourself outlets are under pressure, and it talks to the consumer that are a bit strained with high interest rates and high inflation. So all those factors impacted, I would say, the rest of the value chain. Then you also have a subsidiary, Sunshine Seedlings. It's a wholesale nursery based in Pietermaritzburg in KwaZulu-Natal. Still reported solid results for the year. However, the fires in KZN also had an impact on the results of that business. And then lastly, from a Peak Timber Plantations, just for the audience that is not too familiar with TWK, we have plantations in South Africa, but most of our plantations is in Eswatini, and we refer to those plantations as Peak Timber Plantations. Sales were down because of the fires and the market conditions that we've seen over the last financial year. If I can continue with retail and mechanization, I think this is a segment of the last 2 years in TWK that has been under quite some financial strain. And just in overview, I think if you, I'm sure that most of you also read up about what's happening in the rest of the industry, is market conditions are quite tough out there. I think with El Nino and the previous summer crops that were lower than expected, yields were down. It was the environment where farmers paid high interest rates, load shedding still had an impact, diesel costs were high, and all those factors coming together impacted the spending and what available spending and impacted the results of our retail and mechanization division. So there you can see revenue decreased by 3%. However, there was an EBITDA increase it's quite a substantial percentage of 304.7%. The reason for that is our improved performance that we've seen from the prior year by Constantia Fertilizer. That turnaround was supported by sales volumes. As you can see, the sales increased by 4.5%. And then also the fertilizer sales were also supported by a more stable international fertilizer market. In the prior year, prices were quite volatile, and it made it very difficult to manage that. So you end up with very expensive stock that you need to sell at lower prices. However, more stable international prices together with a change in the procurement policy of fertilizer in the group contributed to increased margins in that subsidiary. What we've also seen in our retail and mechanization segment is mechanization. I think farmers, it is an outflow of lower yields and the macroeconomic conditions that I spoke to earlier. But overall, mechanization sales were down. TWK owns in New Holland agencies, but also other agencies. And then there you can see whole good sales were down by 22.4%. And then what we've seen, sales from our other agencies down by 44.3%. This is not something that I believe is unique to TWK. I think we also see that nationally, that whole good sales are down with about 30%. And it talks to the financial strain our farmers are under. And then also, I think there was some uncertainty about in the lead to the elections in terms of how that will play out and how that will impact the industry. So in that uncertainty, people, consumers and farmers tend to spend less, and that also had an impact in terms of the results that we've seen in mechanization. I think lastly, other influencing factors, I already spoke to those factors in the feedback that I've given. But yes, I think in short, very difficult conditions for this segment, improved performance from Constantia, however, a very focused segment for us as well in terms of the service that it provides to the farmer, and a lot of work is being done in the space to make sure that we increase those margins and EBITDA. Financial services. Financial services is our segment consisting out of our insurance as well as our financing businesses. Good growth that we've seen in this segment. Revenue and EBITDA increased revenue by 4.1% and EBITDA by 22.8%. From the insurance side, I think that growth was supported by growth that we've seen in the businesses itself, especially in short-term insurance. We've seen a 0.6% increase in total crop insurance premiums that contributed to a 0.5% rise in commission that we've received. We also have medical insurance books, and we've seen an 18% increase in commission that we've earned there, and then a 14% increase in funeral insurance active policies. So I think from a short-term insurance perspective, good growth that we've seen on the current base that we have, and also making use of cross-selling opportunities within the business. Together with that, there was also some acquisitions, and I did refer to that when I gave feedback on the cash flow statement. We bought 100% in Galinga Risk Services and Albinel Markelos, and then we bought agency insurance rights of TLC Brokers International. In the credit division, as Andre said, they provide financing to the farmers. However, there was a bit of a decline in the production book that we've seen of 12.9%. The book peaked at about 99 million, and that contributed to the net decrease in interest received of 0.5%. However, the book is well managed. We have adequate security in place to cover our credit risk in that book. And as you can see there, our bad debts written off as a percentage of the total book is currently 0.7%, which is, I think, a very good ratio, and it talks to how well the book is managed despite difficult conditions that we've seen out there and farmers that are under financial strain. Then lastly, some feedback on our grain division. A good growth that we've seen there in revenue, and that growth was supported by that growth of 35.2% was supported by growth in market share and more volumes traded especially in our grain marketing business unit. So the grain segment consists mostly out of a grain marketing business, grain storage, and then we also have maize mills in that segment. So grain marketing performed quite well. That was supported by new grain traders that we've appointed, and then a growth in market share. Grain storage also a very good growth that we see, and it was due to better yields that we've received in the areas of storage facilities are. And then lastly, the grain mill businesses, unfortunately, they had a very, very difficult year. That was due to the high volatile white maize prices, and our margins were severely under pressure. One of the mills is in Eswatini, and the other one is in Makonde. Both of the mills really had some difficulties to realize appropriate margins. And then together with that, we could also see that consumers are under pressure, and we could not perform against our budget in the last financial year. So this is in short, and then I will hand over to you again, Andre.
Thank you, Andre. I think that's important to give feedback on the year that passed, but I think it's also important that we look forward and see what we see for the future out for us. First of all, I think we're cautiously optimistic about the year 2025. Like any good farmer, we are always optimistic. But the reason why we are optimistic is, first of all, we believe there's a more positive market sentiment. I believe that the outcome of the elections definitely played a role in this more positive market sentiment, specific in South Africa. And also the lower interest rates. Hopefully we will get a good cut this today. Then, of course, that always plays a big role in our business is the weather. There's a La Nina weather pattern, and that means there's better rainfall, or at least we'll have a normal rainfall that will be better than the previous year. If we're looking at every business unit itself, the timber business, we definitely expect a robust sales volumes. Our order book is full, but unfortunately, that's going to be offset a bit against a stronger rand at this stage, as well as some lower pricing internationally. So we did about 666,000 tons of export. This year, we hope we can get to that 900,000 tons that we're looking to export from our export site. Looking at retail and mechanization, the segment should benefit from improved macroeconomic conditions. Then our financial services business will continue to grow our footprint. This is specifically in the insurance side. And then, of course, the acquisitions that Andre also mentioned, and possibly new acquisitions we're going to do in the new year, would definitely contribute positively to the growth of this segment. The grain segment, the outlook, that will definitely be mixed bag. Our grain storage and also our marketing business will definitely do well. Unfortunately, also the first part of 2025, the grain milling business will remain under pressure with the high white maize price at this stage. Unfortunately, we cannot get the price in the market. The customers are under pressure. So unfortunately, that is a business that could be under pressure. But I think looking at overall, the group strategy remains resolute, and we will unlock shareholder value over the long term. Specifically, if we look where our share price, Andre also alluded to that our share price is at a stage, I think, not even 42% of our net asset value. So I think if you are an investor and you're looking to invest now, it's definitely a very, very good time to invest. Of course, in the long term, we will definitely unlock some value, and you will definitely reap the success of that as well. I think it's also important to just mention what do TWK stand for, what is our DNA, what do we try to live and breathe every day, and I think that's our values. That's a very important part of every business, and that's accountability, growing trust, resilience, and innovation. I think that it's not something that's only on the wall at the head office. We're really trying to live that in our business. If we're looking at our strategy is first of all the key value drivers that I already mentioned. Then if we're looking at our stakeholders, definitely our customers is on top of that. We strive to be the supplier of choice, and we also want to be the market of choice to them. Secondly, our strategy is built around our financial performance. At the end, we want to be the investment of choice. It doesn't look at this stage at our share price. We still have some work to do in our strategy to get to be the investment of choice. If you're looking thirdly at the process excellence, that's part of our strategy to improve that. And lastly, also we have a strategy around our people, digital transformation, because we really want to be also the employer of choice. That's in short the strategy at this stage. Thank you very much.
Thanks, Andre. And I've got a whole plethora of questions that came in there while you and Andre were talking through the slides. The first one, maybe we'll tackle off is, you know, you mentioned the discount to, you know, NTA there in the second last slide. Just interested to hear what initiatives management are considering in light of that, you know, whether that's, you know, buybacks potentially in the offing, a change of the dividend policy for, you know, buybacks versus, you know, dividends. I know also Andrew mentioned when she was going through the financials, you know, the gearing has come down, you know, quite substantially over the last 12 months. So obviously that'll free up capital for other initiatives. So maybe just give us thinking on, you know, what you're thinking, the board is thinking.
Yeah, maybe I can take it. I think the board is always looking at the kind of a balanced approach. You know, we have to, they're looking to be dividends, but also looking at the debt and bringing the debt down, but also paying dividends. So it's a bit of trying to balance that act, and I think to be balanced, that's actually what the board is looking at.
Okay, and I'll come in with a second one here. You mentioned, you know, the weather. We late rains up where you guys are there versus where I'm here in Stellenbosch. But you know, what's the feedback? You know, when the sales trips and stuff are going around, talking to farms and talking to farmers, are they? You know, it might have been a bit of a late start, but are they generally positive on a year-over-year crop rebound from last year, which, you know, was a difficult year, without putting, I guess, any lipstick on it?
Yeah, no, I think a farmer is always positive. You have to be, if you're a farmer, you have to be positive. But I think definitely, if you're looking at the weather pattern, it's looking much better than the previous year. From the beginning, they have predicted that there's going to be some drought in the last part, and actually it stayed away, and then at crucial time it did happen, like they predicted it. This year the predictions is much better. We started a bit later, like you also mentioned, on the planting season, and they are still busy. But at this stage, I think that it's looking good. Everything that is in the ground already. And also going forward, the weather pattern that I also mentioned is definitely good, and it'll be a good thing, because, you know, a farmer always it's better to have a good yield and a lower price than like it is now, that you have not such a good yield and a high price, because that's not good for anybody. It's better to have a good yield of production and maybe a little bit lower price that so good for the consumer.
I'm gonna the ghost
Maybe
in here.
Yeah.
Question.
Thanks, Mark. Now, Mark let you off a little bit easily on the first one around the share buyback. So I almost want to take us back there a little bit, Andre and Andrew. But yeah, I mean, I guess just for me, looking at those slides, you know, you see your dividend is so consistently growing, but the share price has kind of said, you know, we don't care about the dividend. We're kind of looking at the other stuff, the risk in the business, etc. It feels like a great opportunity for share buybacks. So I almost want to ask it a little bit more directly to say, you know, does the board take this into account? If we're talking about acquisitions, when you can buy your own shares at such a huge discount to net asset value, I mean, that's got to be one of the acquisitions in inverted commas that's kind of on the table. And we've seen some of the smaller caps on the JSE particularly have some really strong share price performance off the back of share buybacks at discounts to NAV. So I just wanted to really bring that to the fore. I mean, maybe it's less of a question, more feedback, I'm not sure. But those two charts next to each other, your dividend and your share price, tell me that, you know, the NAV is a dripping roast right now for you to go and actually do some share buybacks.
Yeah, definitely. That was a big discussion on the board as well, and to allocate some capital to a buyback scheme. But we also, and I cannot say too much, but there's also other things that we want to utilize that capital for. And we must always look from the board side what's going to be the best yield, or strategically going to be the best. And at the end, they decided we rather keep some of that capital, maybe to do an acquisition, rather than that's on the table at this stage. So rather looking at that than buying back the shares right now. but it might change. But it's definitely something that they're considering going forward, and we will definitely look at that. Yeah.
Yeah, I'll leave it there. It's obviously something you guys have planned, so it's going to be interesting to see how it pans out. I'll hand back to Mark.
Just watch space.
Yeah. Another question, again, yeah. My family involved in farming back in Ireland. My grandfather used to say, farming is weather and weather is farming. But this one is around, what are you guys doing to try and mitigate the risk of losing income on the grain side of the business? Just given, we've seen over the last 10 or 15 years, an increase in extreme weather, if I can say that. Yes, there's cycles of drought and good years and bad years, but when we get a good year now, it's particularly good, but on the bad years they're also particularly bad when we get really adverse weather. So maybe just talk through what are you trying to do to the extent that you can to dampen down your risk in terms of the grain side of the business as it pertains to weather events.
You can fill on, Andre. But I think the biggest thing from a bad cycle in the grain is not always that it impacted the grain. It impacted the grain specifically on the storage side. Yes, there we have an impact, but and maybe on the milling side as well, if the price is high. But it also had a big impact on our retail side, because then if the farmers doesn't have that spending capital, then they also the trading side is a bit on a pressure. But what we're doing on the grain side specifically is we're trading different commodities, and that's also where we're growing. You'll see, and I'll make a bit of mention of that we're trading commodities and also only grain. So we're looking to trade more other commodities as well, and also play in more commodities than only white and yellow maize, so only the grain side of and soyas. But so that is one of the big things that we're looking to do on that side of the business to grow it. You can add as well, Andre, if you want.
No, I think, Andre, you've concluded on that. I think it's weather is probably the most difficult, sometimes how you would manage that. But I think, and that's what's important, that you need to understand, and I think that's the benefit of this model, and that's why we are a diversified group, is you need to manage it from a group perspective, and how you diversify those risks from a group perspective. And because sometimes a bad thing in one division might be a good thing in another one, So it's so for me, it's rather to look at also from a broader perspective and say, well, how do you manage that from a group perspective, but then also make some changes within that division as need be.
I would like to ask about insurance. First, in terms of your own risks. So, you've obviously had this fire issue, and you guys did receive quite a big insurance claim on that. Just for investors to understand, is it comprehensive insurance? Are you able to get back basically everything you've lost, or is it a situation where you carry a piece of the risk? So that's the first part of the question, is your own insurance. And then the second part is in your insurance business. I think I've asked this before on Unlock the Stock, but it's always worth making sure. I just want to check whether or not you carry any underwriting risk at all. I don't think you do. I think you just earn commissions and the underwriting risk sits elsewhere. But yeah, just sort of both sides of the insurance, just understanding that a bit better.
So the first answer on the second part of the question, our insurance business is now, we don't have any reinsurance risk there. It's a brokerage business model, so we only receive commission. In terms of the group's own insurance, we have our own sales structures in place. So in that cell, you're correct, there's a portion that we are self-insured. However, for the remaining portion, we have reinsurance in place and we are fully covered. But the first portion in the cell, we are self-insured.
And just maybe if we change gears a bit over to the timber business, obviously the rand, we were going one way there for a while post-election. Now with Trump, we seem, after another election, we seem to be going the other way. But obviously, Richards Bay, as you said, has, the second half was much better than the first half. In terms of volumes, are we kind of getting back to a 2023 normalized year if we look out forward to this year, and obviously pricing then as well? Or are we actually seeing you go see, you know, even further growth within the timber business from a volumes perspective, or where should we be kind of thinking of what this year is kind of going to look like, given last year was really a kind of a tale of two halves?
Maybe I can start with in South Africa itself. Locally, the market is still very challenging. In the mining sector, it's not a growing industry, but we have there's some shaft that closed down that has impacted our business in the mining sector. Structural timber, that's actually the biggest one that's still down. We still have not seen big buildings coming through on the structural side. I think that what's still interesting is that our pole business is doing a bit better, but maybe that's more that we're getting market share rather than the total overall business. So South Africa it's not going to be volume-wise growing much. But if you're looking internationally from our export side, that is definitely growing. There's a big demand, even like last year, and that's also why it hit us so hard. We were our inventory, we were full when the fire happened. We sit with much more than we normally sit because the shipments was going to come in. So that is definitely, unfortunately, the rent is a bit so. If you're looking at the profit we're going to make, it's going to be a little bit less. Also, the prices internationally a little bit under pressure, but definitely it's demand.
I'd like to ask about roof space, if that's okay. I know it's probably also a tricky one for you to answer. So not a detailed question per se, but I'm guessing what's happened there is that, what's made it a lot harder to sell, or certainly at the price you thought you were going to get, is the magical disappearance of load shedding, which hasn't done anyone in the solar industry any favors at all. I'm guessing that's what the challenge probably is there. I guess maybe it's a broader question, for your business, which is very focused on kind of all these peripheral things around this agriculture industry. And yes, there's these 4 pillars. You've talked to the potential for further acquisitions. There's obviously stuff you're looking at. How do you make sure you don't lose that focus and maybe get into some other non-core stuff where in a year or 2 years or 3 years, we're talking about something that you need to sell, or you're looking to get out of, or it hasn't quite worked out? Maybe just some lessons learned, just to give investors maybe some more confidence in capital allocation, because I think that will also drive the share price over time. If the capital allocation works out well, that's always very good for evaluation. And unfortunately, the reverse is also.
I think you muted. We've lost the
Sorry,
sound.
I was done. Sorry, I was done asking the question.
Okay, great. I'll take one part, and you can just fill on. Maybe if I start at the end of your question, we definitely, maybe I'll start at the beginning with roof space. Roof space. The problem with why we have to cancel that deal is one of the biggest owners of the malls. They have stopped payment in the contract. All the debtors have to be settled, and but we are in arbitration with that specific mall owner that owns the biggest part of the malls that we put the solar on. So that is the reason why it was problematic. And at the end of the day, we will try and settle the arbitration, and then we will have to try and sell it. But like you mentioned, it's not worth the same than it used to be. But we're definitely going to this year try and sell that the moment we are finished with the arbitration. It's taking much longer than we thought from the beginning. Just going a bit further, I don't know what you want to add maybe on that. Just going further on the next question that you have, and Andre, you can add on that, is that we said that you asked about focusing on strategic business. I think we have a very, very focused, even on our strategic business, and that's why we're selling some of this business like motors and so on. But even on what we say is core business. And that's what I said, even in our core business, there's some assets that's not aligned with our strategy within our core business. And we're even looking to sell those. So we're going to be very focused on what the strategy is. Even if it is core business, it is still part of our strategy within the core business. And we're looking long term. So that's why definitely we are focused on that for sure.
Yeah, and just to ask you, I agree with you in terms of your capital allocation, and how do you get comfort that you don't end up in this position in 3 years' time again? I think that is also through direction that the board has given us. We had a very detailed strategy session with the board. I think we've really looked at the year, as well as, I would say, a roof space condition and lessons learned. So I think we have a very good focus. I think it's quite clear from the board as well as management what we need to focus on, and what are the areas that we need to allocate our capital on, and what are the returns that we are looking for, and what is core. So I think there's a lot of focus in that area currently.
If I can maybe touch on, the highlighted result was obviously the financial services division. Very nice numbers on the top line and the bottom line. I'm just wondering, is there, further scope to grow that division? And if the answer is yes, is it going to come from, penetration of, products within to, the existing customer base, people who are not on the medical aid, but they're using maybe the crop insurance, get them across, or vice versa? Or is it actually adding in more products? Andre, I think the last time you were on here, we talked about, potentially, an RA offering tie-up with another provider. So maybe just give us your thoughts on, the growth potential within the financial services business.
It's definitely one of our focus areas. I would say both of the above. So we're definitely going to look at acquisitions. That's also part, but also growing within the data systems that we have at this stage. So we're going to maybe it's not a nice word, but to mine the data that we have and to do cross-selling. I think that's the important one side of it. But the other side is also that we're going to look and for some acquisitions that we can also add, because this business is doing well. It's less volatile than some of the more agri kind of businesses. So that is the side that we're looking to grow as well, definitely.
I wanted to ask about some of the look through into consumer discretionary. So obviously on the timber side, it's very much the DIY story, and I've been following companies like Cashbuild quite closely. There's starting to be some hope there, starting to get to a point where sales are moving higher. It's quite modest at the moment, but it will hopefully get there. I wanted to ask, in terms of the uptick in consumer discretionary, and I think we're all hoping for an interest rate drop today, pretty much, unless you're a bank. Would a lot of that thinking also apply in your retail and mechanization segment? I mean, is it also that kind of discretionary thinking that comes through there? Obviously, some of that stuff is almost more, day-to-day business and your agri clients. It is a little bit different. I guess that's what I'm trying to understand. How discretionary is that business versus supplying the day-to-day needs of the agri client base, and then it's driven more by how the crops are doing rather than how people are feeling and where the interest rates are?
I think definitely there's a bit of both. Agriculture, of course, it's a bit of a different consumer than only we have consumers. That's the normal people in town. That's the same than any other consumer. But there is some of the consumers. If you're looking at the farmer, the buying pattern is definitely different. He's spending more when it's going better, especially on capital kind of products like machinery and so on. And the moment it's going not as well, then he cuts back. The first thing is he's cutting back maybe on fencing. He's cutting back on the capital side, he's not replacing his tractor this year. He's waiting next year, going to be a better year. Then he's going to replace his tractor. So it's only some of those things that impacted the trade. But there is some of our bigger branches, like in St. Pietermaritzburg, there also is a big component of the town that's buying there, and they have a little bit of strain, and they are buying also a bit less. But it's definitely we can see a bit of an uptick on the, let's say, the town consumer as well. They are buying a bit more, because that's maybe, I don't know why that is, but definitely maybe it's much more of a focus to be not more, but to be bigger in a town that we have, and maybe cater a bit more for those kind of customers as well. So yeah, we're doing a lot of things in the retail space to see if we can grow that business again or improve it, because it has taken a big knock because of our normal client, the farmers that is spending a bit less than it used to be a year or two ago.
Andre, I just wanted to talk about, obviously, we mentioned it earlier, we had the elections, we got a new government, we've got a new Minister for Agriculture, we've got new management at Transnet. I'm just wondering, actually on the ground day to day, are you starting to see like an improving regulatory and, SOE operations environment? Like, is there like green shoots coming through there? We've heard it from a few, different businesses in different industries, now that, new ministers are kind of settling into their portfolios, there is definitely a bit of a change in how things are happening and the speed at which things are happening. So maybe just give us maybe your 2 cents on what you're actually experiencing.
Yeah, there's definitely some green shoots there. Maybe not yet in improving of the regulatory environment itself yet, but if you just look at the attitude and I must say a cultural change, but it's a much more open. You can approach trying to help, trying to make a difference. So we definitely already experienced that, even on the Transnet, the TTP side, in the harbour. It's going much better than it were a few months back when it was fights and we need some lawyers to get ships loaded and offloaded and that kind of things. So there's a much better cooperation between ourselves and the government side. So definitely, I think the biggest improvement at this stage is the attitude. We are not we are definitely seen to try to work together to come to a conclusion, not to work against each other.
Yeah. And I see Vanessa popping up on my screen now, so that's my cue to wrap up here. Andre, baie dankie, and I'll hand back to Vanessa.
Thank you, Mark.
Thank you.
Thank you to everyone who joined us today, and a special thank you to Andre and Andre, who, for the first time since working with Mark Tobin for the past 3 years, has said "baie dankie." So that's good progress. We hope that everyone on the call enjoyed this session with TWK today. And just as a reminder, if you want to watch it again, it'll be available on the YouTube channel next week, which we hope that you will subscribe to as well. Our next Unlock the Stock session is taking place on Thursday, the 5th of December, and that will involve a new company to unlock the stock, KAL Group. And with that note, I am going to say thank you very much to everyone again from my side for joining, and goodbye.